If I handed you 100,000 Kenyan shillings today, what would you do with it? Would you save it? Invest it? Or maybe spend it on something you've wanted for months? What you decide to do with that 100K reveals exactly how close, or far, you are from financial freedom. Most young Kenyans think they need millions to start investing. But what if you started with just 100K and used it the right way? Over 70% of young professionals in Kenya save less than 10% of their income. No wonder so many of us feel like we're working hard but not moving forward. In this video, I'll show you how to use that 100,000 Kenyan shillings to start building real financial freedom even if you're just getting started. Let's start with a question. What does financial freedom actually mean? It's not about quitting your job, buying a fancy house, or living a soft life on the beach. It's about having choices. The choice to work because you want to, not because you have to. The choice to pursue a business idea. The choice to live on your terms without money dictating every decision. The choice to take a risk, to rest, or to walk away from a toxic job because you're financially secure. When you got your first job, you probably thought financial freedom meant buying your first car. Later, you realized it's not about what you buy, but about what you own and control. Most young high-income earners are hustling hard, earning more than ever before, yet many still feel stuck. Because high income doesn't equal financial freedom. Freedom comes when your money starts working for you, even when you're asleep. And that's where it all begins, controlling where your money goes, not just how much you make. Before you think of stocks, bonds, or side hustles, you need a strong financial foundation. Let's talk about the 3 pillars that protect your money before it grows. An emergency fund isn't optional, it's your first line of defense. Think of it as your personal shock absorber. When life throws surprises such as medical bills, job loss, or car repairs, this fund keeps you stable. If you don't have a cushion, you'll always be one crisis away from starting over. So how much should you save? Ideally, 3 to 6 months of your expenses in a money market fund, where it earns interest but remains easily accessible. However, the typical 3 to 6 months of savings may fall short, especially for young high-income earners with steeper living costs. Aim for 9 to 12 months of expenses for greater security. For example, if your monthly expenses are 30K, your goal should be between 270K and 360K. The moment you have that safety net, your confidence to invest skyrockets. Because you're not investing out of fear but from a position of strength. Now, let's talk about something most people ignore: debt. You can't build wealth while paying everyone else's interest. Clearing your high-interest debt is one of the best investments you can ever make. Here's why. If you're paying 16% on a credit card or mobile loan, that's guaranteed money leaving your pocket. Paying that off gives you an instant 16% return, something even the best investment can't promise safely. For example, if you clear a 50,000 Kenyan shillings loan at 18%, you save 9,000 Kenyan shillings per year. That's real money you keep. Use the avalanche method, pay off the most expensive debts first, then move down the list. It's simple, effective, and frees your cash flow faster than you think. Once your financial base is strong, investing becomes easier and less stressful. Here's something most young high-income earners overlook: your brain can deliver better returns than any stock market. Invest part of that 100K in financial literacy, books, workshops, or a financial coach who can help you plan your money intentionally. Because the more you understand money, the more power you have to multiply it. Think of it as the smarter your decisions, the faster your freedom. Financial freedom isn't about luck, it's about structure. Before you grow your money, you have to protect it. And before you protect it, you have to control it. Your 100K can transform your financial life, but only if you start with the right mindset and foundation. Now I am going to show you exactly how to make that 100,000 Kenyan shillings work for you. So you've got 100,000 Kenyan shillings sitting in your account, and you're wondering, what's the smartest way to make it grow? You're not alone. Most young professionals in Kenya work hard for their money, but very few make their money work for them because they are afraid to move from a saver to an investor. Here's a mindset shift: saving keeps you safe but investing builds your future. Saving is defensive but investing is offensive. You need both to win the game of wealth. The goal isn't to chase every new trend, it's to choose what fits you, your goals, your risk appetite, and your timeline. Let's talk about where to invest that 100K. If you're new to investing, this is your safest entry point. A money market fund is like a smart savings account. It earns you interest daily, but you can withdraw anytime. For example, if you invest 100,000 Kenyan shillings in a fund yielding 11%, you'll earn 11,000 Kenyan shillings per year, risk-free. MMFs are perfect for short-term goals, building your emergency fund, and parking money while you explore other options. These are government-issued investments that pay you interest every 6 months. Think of them as Kenya's safest long-term loan, but you're the one earning from it. You can start with 50,000 Kenyan shillings via brokers or your bank's Central Bank of Kenya portal. Treasury bonds are perfect for long-term goals such as retirement or education savings, and for anyone who values stability over speed. Now let's talk about stocks, the growth engine. When you buy shares in companies like Safaricom, Equity, or KCB, you're not just a customer, you're an owner. But here's the thing, stocks go up and down. So you don't invest for today, you invest for the next decade. Start small, diversify, and stay patient. If you prefer a community-driven approach, consider a SACCO. SACCOs allow you to save, borrow, and invest collectively while earning annual dividends. It's a great middle ground for those who want stability, discipline, and access to affordable credit. However, choose regulated SACCOs with strong track records, not just those promising high dividends. Now let's put this together. Here's how you can divide your 100,000 Kenyan shillings for balanced growth. First, put 40%, that's 40,000 Kenyan shillings, into a money market fund. This is your liquidity zone, cash that's earning returns, but still accessible if you need it. Think of it as your short-term safety net that also works for you. Then put 20%, which is 20,000 Kenyan shillings into stocks. This is your growth engine. Over time this portion can outperform everything else, but it also comes with higher risk. Next, 30%, which is 30,000 Kenyan shillings into treasury bonds. This gives your portfolio stability. It's low risk, steady, and helps balance out market swings. Finally, use 10%, which is 10,000 Kenyan shillings to invest in yourself. Consider books, coaching, or courses that sharpen your money skills because the best investment you'll ever make is in your financial knowledge. This mix gives you safety, income, and growth, the perfect trio for new investors. Here are 3 tips for first-time investors. Tip 1, start small, but start now. Waiting for the perfect time costs you compound growth. Tip 2, automate your savings and treat investing like paying a bill. And lastly, review quarterly then adjust as your income and goals evolve. Remember, wealth is built through consistency, not luck. And that's how you make 100,000 Kenyan shillings work smarter, not harder. Now I am going to show you how to create multiple streams of income, because financial freedom isn't built on a single paycheck. I'll show you how to turn your skills, savings, and smart investments into diverse income sources so your money keeps flowing even when you're not working. Let's be honest, one income stream is no longer enough. If your job ended today, how long could you sustain your lifestyle? That's why building multiple streams of income isn't just a financial strategy, it's financial protection. Let's talk about how real wealth is built. But before we get into the strategies, keep in mind that wealth is not about how much you earn, it's about how many streams of income you have. Most people have one income and many expenses, but wealthy people have many incomes and controlled expenses. To shift into wealth mode, start asking, how can I make money flow to me, even when I'm not working? That's the foundation of financial freedom. Now let's discuss the various income streams you should have. This is your primary job or business, and where most of us start, your salary, consultancy fees, or main hustle. However, you should use your active income to build passive income. Every month, aim to save 20 to 30% of your earnings for investing, not just for spending. Your job should fund your freedom, not your lifestyle. Unfortunately, most of us use our jobs to fund flashy lifestyles. This allows your money to work for you and comes from the investments I covered earlier. Examples include money market funds for short-term gains, treasury bonds for stability, stocks and ETFs for long-term growth, and SACCOs for dividends and borrowing power. Each one becomes a mini income stream. Think of it this way, your 100K investment is like planting a tree. Every month, those trees grow, multiply, and pay you shade and fruit. Now, this is where your creativity shines. You can build extra income from freelancing or consulting online, creating digital products, for example, ebooks or online courses, YouTube or content creation, and e-commerce or reselling products. Start with what you already know. Your skills are your currency. You don't have to wait for extra money. Just leverage what you already have: knowledge, consistency, and the internet. That's how many Kenyan professionals are growing their income today. This includes real estate, land appreciation, or even rental properties. You don't need millions to start. You can invest in REITs, real estate investment trusts, for as little as 5,000 Kenyan shillings. The goal is simple: own something that appreciates while you sleep. Let's put this together. Here's a simple system you can follow. Earn through your job or business, save consistently and automatically, invest in diversified, income-producing assets, grow by reinvesting returns, and multiply through side hustles or scalable income. That's how ordinary income becomes generational wealth. Now, let's do a quick reality check. Here's what stops most young high-income earners from building wealth. Lifestyle inflation: every time income increases, spending rises too. Fear of risk: staying stuck in saving-only mode. Lack of strategy: investing randomly without clear goals. So what is the fix? Have a clear financial plan, track your progress quarterly, and invest in financial coaching, because sometimes you need a roadmap and a mentor to stay consistent. Wealth isn't built overnight, it's built intentionally. If you start today, in 3 to 5 years, you can create a life where money no longer controls your choices, but you control your money. And if you're ready to invest 500,000 Kenyan shillings, watch this video. I talk about scaling your wealth, diversifying your portfolio, and building true financial independence.